Good morning, everyone. This is just a quick market update video. A pretty brutal week this week. Capped off with, 300 plus point sell off on Friday. And, there's a lot of theories and opinions on why the market got beat up this week. It doesn't help that next week we've got the Fed meeting, and essentially it would be a really big surprise if the Fed does not raise rates up 0.25%. So, what's really happening here? The big excuse is oil. If we look at a chart of oil, oil just got hammered again this week, especially over the last couple of days. We had a mild pop early in the week on inventory reports, but that just gave up the ghost, and all the bottom buyers for the last couple of months threw the towel in, and down we went. But really, this is part of a bigger story that's ongoing right now. The real reason we had a big sell-off on Friday and really this past week has to do with what's going on in the junk bond market is absolutely getting annihilated right now, and this is very, very bearish for the market, at least for large caps. A big driver of this, of course, is the huge sell-off in oil. Most of these big oil companies have gotten highly leveraged over the last couple of years, and the risk of bankruptcy and default in the bond market has exploded. And that came to fruition on Wednesday, Thursday, when one of the big junk bond funds stopped redemptions. And that has set off some panic in the junk bond market right now. Lack of liquidity, and whenever you get that kind of news flow out there, it spreads across the board. Junk bonds, there's a little bit of a quandary right now. When you see a chart like this in junk bonds, usually this is not something that happens before we have the Fed raising interest rates. So it's going to be very interesting to see what happens. This could be the excuse they need to kick the can down the road, or they may just raise it despite what's going on in the oil market and in the junk bond market. But it's something we definitely have to keep an eye on in the next few days. Come Monday, looking at let's go back to the Dow chart. We broke down. We couldn't break through that downtrend line resistance going back to the highs, so we retraced, and we do have mild support here at the 17K level. Now, we had some positive data that can be spun positive from China. Is it going to be enough for them to bounce the market back on Monday? We got a pretty brutal sell-off here on Friday, so I'd be very surprised if we don't, after some margin call selling on the open on Monday, see some sort of bounce back. Now, an indice that we talked about last week that we needed to see breakout in order for this rally to have legs was, of course, the Dow Transports, and the Dow Transports have absolutely gotten annihilated. Crazy as it sounds, when transportation stocks, when their major cost input has been continuing to drop, it's actually dropping with oil. Go figure that out. And we are right at a support line here, a triple bottom on the Dow Transports. This needs to hold. I've been saying it for weeks and weeks and weeks that how goes the Dow Transports goes the market, and that's kind of not been reflected in the Dow chart over the last several weeks. But if we see another breakdown in the transports, we could see some pain in the large cap stocks. We've gotten deeply oversold on MACD here on the transport, so some sort of bounce back should be had. Now, of course, small caps, micro cap indices usually always follow the Dow Transports. That's just the way it is, and down we went. A big sell-off over the last couple of days, so not uncommon, as I preached in the chat room on Monday and all week, where we pretty much sat on our hands. I have a notation in my notes that this past week and the next few days are a hand-sit time in the market almost every single year in the kind of stocks we trade. This is when the tax selling hits a crescendo, and especially with probably the most anticipated Fed meeting in many, many years coming up on Wednesday, there's no point in us moving in any sort of way into anything but, day trades until we get past the Fed meeting and we see what the market's going to do. Then we can start picking up our January popper plays for the inevitable bounce, hopefully, into the new year. So that's where we stand going into this week. Going to be taking a mostly hand-sit approach. I mean, the decimation has been widespread. Look at Disney. Disney has one of their biggest movies ever coming out this upcoming week, and the stock has dropped $10 over the last couple of weeks, and big sell-off on Friday, even broke down below the 200-day moving average. I mean, if Disney can't get going with all the hype that's out there, I don't know what to say about the market. We did pick up a couple of plays this week. Low floats seem to be back in vogue. CHCI is a definite candidate for a very big breakout. 20-day 190 to $2 level is where the big chasers will come in. If these guys pumped out a PR, this one would be off to the races. It could double in short order, especially with 20% of the float short. Another one we're looking at, Neuro, another post-reverse split play that hasn't had a big move yet. So aside from this, watching a lot of the little penny stocks, those are usually the ones that outperform, but very negative vibe in the market going into this week. We'll probably see a bounce back on Monday, but we could see more of the same, especially with the Fed this week. So my suggestion is take a high cash approach, and in the next couple of days, let's see what the market does. If we see some sort of bounce back in the junk bond market, and then let's see what the Fed does. Fed is going to be a major wild card this week, and usually on Fed weeks, it's best to hand sit or take an intraday approach. So that's it for the video, guys. Have an awesome weekend, and see you all on Monday. Bye.